Hi there, Alan here, and we're going to start talking about our last chapter, Chapter 9. This will be an extract, seriously. I'm only going to touch on a couple of points from Chapter 9 because really that's all the time we have left allotted to us in this semester as we start wrapping our business up. So in Chapter 8 we discussed inventory and how inventory assumptions are made, how we capitalize costs, how we carry inventory at cost, okay? And now in Chapter 9, we're going to talk about one little twist on that because accountants, we carry our inventory at cost, but accountants have a little bit of flexibility in the manner in which they take cost out. We put it into inventory at cost, but when we take it out, are we taking stuff out at the oldest price or the newest price? Because prices are always going to change unless you're in a very extraordinary position, okay? And generally, history shows that prices will tend to rise. Prices will be inflationary. So when you buy inventory in January, you might buy it at a certain price. When you buy it again in March, it might be a little higher, and in June, higher again. So do you always assume you take the oldest stuff out, or the newest, or an average? How do you deal with that? So this chapter is all about relieving inventory. Chapter 8 was about putting it into inventory. Chapter 9 is about the choices accountants make when they take inventory out when they sell it. Okay, so that means that when costs do vary, and again in this chapter we're going to assume the reality that they usually will be going up. Okay, we have to make sure that we tell our readers what type of inventory relief methods we use. And again, accountants have a choice. GAAP provides us with that choice. All right? So you can't really read a set of financial statements and really appreciate the data they're conveying to you in inventory and in cost of goods sold without understanding the method that they use. This chapter, well, look at it this way. When you have inventory and when you add to inventory, that's what you have. Okay? Now, when you take anything out of inventory, either it goes and someone buys it, or you still have it. Those are the two choices. You have it, you add to it. That's what you have. What do you do with it? You sell it and it's not here anymore, or you haven't sold it and it's still here. So, putting things in is what Chapter 8 was about. Taking things out is what Chapter 9 is about. So, we call that the cost flow assumption. It's very unlikely that the cost of your inventory items will not change. In all likelihood, they will. Sometimes they'll fluctuate, go up, go down. In the early 80s, in the 1980s, we saw a period of deflation. That's very rare. Usually, prices will tend to go up, okay? Sometimes by a lot, sometimes by a little bit, but they will change. Okay, so you need to select cost flow assumption, in other words, which items you're taking out of inventory, to make sure that you're fairly pricing what you sold, cost of goods sold, right? And what you still have left, your ending inventory. All right, everything is about moving things out when you sell it, and that means it has to come out of inventory at a certain cost. Right? So we're talking about a cost flow assumption that will decide how you report, how you price your ending inventory and your cost of goods sold. Now remember, picture this as one big T account, okay? You start with inventory, you add to inventory at cost. That's what you've got. One of two things happens. You sell it and it goes, or you still have it. That's like one big equation, okay? What you have available to sell either is sold or it's not sold. How you price what you sell and what you don't sell is what this chapter deals with. So now we're going to talk about a very, very simple assumption here, friends. We're looking at the month of December, and we're talking about a store in its simplest form that has $120 worth of cash, okay? So, on December 2nd, we go out and we buy one shirt for 50 bucks. On December 29, we buy another one for 70 bucks. Whoa, price went up. But in all other respects, these two shirts are identical, okay? It's simply that the cost went up. So we spent our 120 bucks. We've got one shirt with 50 in our inventory at cost and one worth 70. And now, on the last day of the year, we're going to sell one shirt for cash of 110 bucks. All right, now listen. When you sell something, the sale price is the sale price. We mark things up from cost in order to sell them for a profit. But the price is the price. How we take inventory out to match that sale is the key here, okay? We sold one shirt. Was it the $50 one? Or was it the $70 one? Now you might say, well, whichever one it is. But no, accounting allows you to decide which one you sold, okay? So let's go on. All right, so at the end of the year, we sold one shirt and we've got one shirt left. Now, these are all the incontrovertible facts. Those are the facts, okay? And we have sales of 110 no matter what. So it's all about assigning a cost to match the sales revenue of $110 for that one shirt. So, okay, you need to say, all right, I had $120 worth of shirts, all right, which one goes? Because I've got to match one cost against that $110 worth of revenue. So I know I sold a shirt and I know I still have a shirt. Which is which? Okay. The first choice is called specific identification. That means I'm not going to make a cost flow assumption. I'm going to keep track of which shirt is which. And if I sell the one that I bought for $50, that's my cost. If I sell the one that I bought for $70, that's the cost. Okay? Now, we use specific identification not for shirts, because let's face it, you're going to buy, if you're a retailer, you're going to buy shirts by the hundreds, okay? So you can't really keep track of shirts. When you use specific identification, that is the item I bought, that's how much cost goes against this sale, okay? We use that for big ticket items. Think of custom-made limousines, custom yachts, custom wedding gowns, heavy equipment, bulldozers, things like that. You are going to have to keep track of each item individually. That's not a cost flow assumption. That is specific identification, okay? We're going to keep track of each individual piece of inventory for high ticket items, okay? Now, if all of your items look alike, that's not practical. This is only practical if you're selling things that are highly unique and customized and identifiable from each other, okay? This is a cost flow assumption. This is different. This is called FIFO. First in, first out, FIFO, F-I-F-O. And that means I don't care which shirt you sell. It doesn't matter. You're going to assume that you sold a shirt. The earliest one, the latest one, that's a cost flow assumption. So in this case, FIFO, first in, first out, means that you're assuming that whatever you bought earliest is the one you're going to sell. It doesn't have to be the specific item. You're going to assume it's that item. You just have two shirts sitting there. Which is which? Mix them up. I don't know. I'm just going to assume whatever shirt I pick to sell, it's going to be the earliest one. And I look at my records. Ooh, $50. Okay. I bought my $50 shirt first, so I'm assuming that is the one that I sold. Okay? And that, therefore, is the amount I'm going to take out of my inventory and transfer to cost of goods sold. All right. Now remember, what I have available to sell, $120 worth of shirts, okay, must be either sold or is still here. Those are your only choices, friends. You might say to yourself, oh, what about writing something off if it disappears? Forget about that. We're dealing only with the basics, okay? So in FIFO, we know that we bought one shirt at $50 and we bought one at $70, but we bought the $50 shirt first, so that's the one we're going to assume that we sold. So we're going to debit cost of goods sold for $50 and credit inventory for $50. What does that leave behind? It leaves behind the $70 shirt. I don't care which shirt it is. We're assuming it's the more expensive shirt because we bought the shirt that we sold first at a cheaper price. So what is our FIFO standing? Cost of goods sold. All right, $50. What is our gross profit? Well, we sold it for $110. We're assuming that it was the $50 shirt. So that means our gross profit is $60. Oh, do you see the games we can play with this, guys? And that means if we sold a $50 shirt, the $70 shirt remains in inventory. Cost of goods sold plus ending inventory will always have to be equal to what it is you had available for sale. Okay? All right. Now, we're always going to assume that prices are rising. Sometimes they may not. But when prices are rising, the earliest cost goes to cost of goods sold, and the latest and more expensive goods remain behind in our ending inventory. That means our inventory balance will be higher, and our net income will be higher. Why? Because cost of goods sold is lower. We sold the cheaper shirt in our minds, okay? The opposite of FIFO is LIFO, L-I-F-O. Under LIFO, friends, we assume that the items that we bought most recently are the ones that we get rid of first, okay? Now, we bought the $70 shirt last, so we're going to assume that is the one that we sell, okay? So, here's what happens. When we relieve our inventory, we're going to take out the $70 shirt. So cost of goods sold is debited, increasing expense for 70. And inventory will be relieved by 70. Now we had $120 worth of shirts, 2 shirts to sell. We're taking $70 out, leaving the $50 one behind. Cost of goods sold, therefore, is $70. Gross profit, again, the $110 sale price, that's fixed. We can't mess with that. That's $110 minus the $70 of the cost of goods sold. So our gross profit is 40. It's lower, okay? Before, it was 60. Now it's 40, okay? That's the difference in the 2 shirts, $20. Our ending inventory, if we sold the $70 shirt, leaves the $50 one behind. So, during inflationary periods when prices are rising, the more expensive goods are moved to cost of goods sold. That means income is lower. The cheaper, earlier shirt remains in ending inventory. That's the $50 shirt. So ending inventory is lower. Net income is lower as well because we assumed a more expensive shirt was costed out against that $110 sale. And there you have FIFO and LIFO. Now you'll notice something. Cost of goods sold under LIFO was $70 and ending inventory was 50. Okay, under FIFO, cost of goods sold was 50, ending inventory was 70. No matter what happens, those numbers, ending inventory plus your cost of goods sold, must add up to $120. That doesn't change. All we're doing here is playing with which item goes to cost of goods sold and comes out of inventory. This is all a shell game, ladies and gentlemen. Okay? Now there's the third, actually there are several other methods of inventory accounting, but FIFO and LIFO are the most common. And this one, averaging, pretty much assumes that you're just going to put everything in inventory, average it out, and say, I don't care what shirt it was, just take something out. I've got 2 shirts worth a total of $120. Grab one of them. What's the average price? 120 divided by 2 is $60. Okay, that's fine. I'll average my cost, and I'll assume every shirt that I have is worth $60. So when I pull a shirt out, it's going to be $60. That goes to cost of goods sold and is relieved out of inventory at $60. It's going to fall in between FIFO and LIFO. Okay? Cost of goods sold in this case would be 60. Gross profit, therefore, would be 50. And ending inventory is 60. Cost of goods sold, 60 plus ending inventory of 60 is $120. There it is. You've got your $120 no matter which assumption you use. FIFO, LIFO, or averaging. Now that, essentially, ladies and gentlemen, is the essence of Chapter 9. Okay? Please understand this as we go into our final quiz. Okay. Averaging is not really all that popular because it was kind of a shortcut in the old days. And now that we have easy access to computers, very cheap computers, very cheap software. Even small businesses can keep track of their inventory more comprehensively and more consistently than they could in the old days. Okay, so I, in my several decades of experience in the wonderful world of accounting, have not seen averaging used, although it is in the book, it is cited as being used by Bristol Myers Squibb, big pharmaceutical company. I'm citing page 324. Okay. Averaging, as the book says, does not offer the benefits that make FIFO and LIFO so appealing. Now, you might say to yourself, well, why do it? Well, because sometimes, friends, you're going to want to come up with a big bottom line to please your owners. Okay, if that's the case, you'll want a lower cost of goods sold, boost your profit. Okay, higher net income. Your shareholders appear to be happier. Okay, LIFO. Why would you use LIFO? Because that's going to drive profit down, because it will save you tax dollars. Remember, you have to pay taxes on your profit unless you elect to be a company that is not taxed, like an S corporation or an LLC. But assuming you do have to pay a tax, if you don't need to show your shareholders a very large bottom line, you may elect LIFO to lower your profit and therefore lower your taxes. Okay? The United States, as far as I know, is the only country in the world that uses LIFO. I don't believe that GAAP in other countries allows LIFO, and that's one of the problems with adopting international financial reporting standards. Okay? All right, very good. Specific identification, in theory, is the most appropriate, obviously, but it's very impossible to apply unless you're selling yachts or bulldozers or very uniquely identifiable items. Okay, so GAAP recognizes FIFO, LIFO, and averaging, and a lot of variations on those. There are many types of LIFO. Okay, they are all allowed under US GAAP. Okay, and you have to make sure that you tell your shareholders, your readers, your lenders, everybody, all stakeholders, which method of inventory costing you are using. Okay. All right. Here's some interesting stats. I'm not into stats myself, but if you're curious, less than 1% of all U.S. corporations use LIFO. I find that quite surprising, honestly. In our book, Walmart uses LIFO, and Johnson & Johnson, a company I love, uses FIFO. Okay. So of the largest U.S. companies, the Fortune 500, 1/3 use LIFO for at least part of their inventories, okay? So there's some stats for you. All right. And this is a good place for us to stop, friends. And then when I come in to do my second lecture on this component, as we wrap up, I'm going to, there we are, I'm going to get into a couple of applications and a couple of examples, and we're going to focus on perpetual FIFO and LIFO, and that's pretty much as far as we will get with this chapter and the semester. So stand by, and I'll post my next lecture very shortly. Thank you very much. Bye.